Good morning and welcome to CRI's 2024 year-end tax planning for individuals and families. In this session, we're going to cover some areas that may be top of mind for folks to strategize, optimize, and maximize some tax planning opportunities as 2024 comes to an end. Before we get into the presentation, let's cover a few housekeeping items. Everyone will be in mute only mode for the duration of the webinar. But if you have any questions, go ahead and post those in the Q&A section of the Zoom platform. We'll try and answer those through that Q&A platform, or if there's any time at the end, we'll try and cover some questions to the general audience, time permitting. Also, a copy of these slides will be posted in the chat soon. So if you'd like a copy, go ahead and go to the chat and download those at your convenience, so you can have a copy either to go along as we do here, or have a copy to go back and revisit as time permits in your schedule. With that, I would like to introduce the presenters for today's webinar. First, we have James Wright. He is a partner in the Niceville, Florida office. He attended the University of Florida, Samford, and Georgetown. In his free time, he likes fishing and being on the lake, as well as watching college football. James has been married for 2 years, but he just had his first child. I'm sure that is keeping James busy as well. Also presenting today is Lucy Brenner. She's a senior manager in our Charleston, South Carolina office. She attended East Carolina University. In her free time, she enjoys walking, dance, and fitness, as well as going to visit Hawaii or Europe. And she also has Penny the pug at home to keep her company. And lastly, I am Chris Hoffman. I am the tax service line leader of CRI. I got both my bachelor's and master's degree from the University of Tennessee. I enjoy watching my hometown teams here in Nashville, Tennessee, the Tennessee Titans and the Predators. My family and I take frequent beach vacations to Hilton Head, South Carolina, close to Lucy there. And we've had a series of Boston Terriers over the years. Our current one is Dash, who likes to greet people by jumping about 5 feet up in the air and trying to lick them. So with that, let's go ahead and get into our agenda for today. With the elections last week, I know politics has been top of mind for folks. So we're going to start today by covering some of the general tax policies of the political parties that have come to the surface over the last couple of months. We'll then transition into expiring provisions under the Tax Cuts and Jobs Act. That was a major act passed a couple years ago, many of them sunsetting, so lots of things to think about as that may come to a close. We'll then go into the 2024 inflation adjustments, numbers you may want to keep in mind as things change for the 2024 filing season. We'll then cover some of the standard and itemized deductions, again, things you may want to consider before 2024 come to an end. Similarly, there's gift considerations, gifting you may want to do before year end. And then we'll wrap up the presentation by covering the Secure Act 2.0 and the various retirement provisions that are within that. So with that, I'm going to hand it off to James Wright, who will get things started today.
Thank you, Chris. Good morning, everybody. We certainly appreciate you all joining us today. So as we all know, there was an election last week, and so we wanted to talk about the tax policies of the different parties. Now, one question may be, because we know that Donald Trump won the presidency, and as of now, the Republicans have control of the Senate. Why we're looking at both sides? Well, mainly because, one, the House of Representatives is still up for grabs as of this morning. And regardless of which side wins, it's going to be a very narrow majority. And as we know from civics classes way back when, for a bill to become law, it's got to go through both the House and the Senate. And with some of the Senate rules, you typically, to avoid the filibuster, you have to have 60% vote inside the Senate. And so one way you do that is you've got to have offsetting revenue provisions for tax policy deductions, so you still maintain a balanced budget. So there will probably, even if the Republican Party were to have all three avenues of government, there would still potentially have to be some willing and dealing to get any tax legislation across the finish line. So what has been went out during the election were, for example, individual tax rates. The Republican platform was to make the provisions of the 2017's Tax Cuts and Jobs Act permanent, exempt Social Security benefits from taxation, exempt tip income from taxation, and exempt overtime pay from taxation. On the Democratic side, they wanted to keep the current tax rates for income less than 400,000, but increased the tax rate back to 39.6%, which was the highest marginal rate prior to the passage of the Tax Cuts and Jobs Act. They're also in favor of exempting tip income. However, they want to increase the Medicare tax to 5% on income above 400,000. As for deductions, both sides want to reinstate unlimited itemized deductions for state and local taxes. Under the Tax Cuts and Jobs Act, there was a cap of $10,000 on state and local taxes. And that upset a lot of people, especially people in high state income tax areas, think California, New York, for example, as well as people that have high property taxes. So that has been some contention. There's been a lot of things the states have tried to do to work around that in order to get that as a federal tax deduction. Some things work, some things haven't. So both sides are kind of willing to reinstate that unlimited deduction and take the cap off. In addition, the Republican platform had proposed the creation of an auto loan interest deduction. Far as capital gains and dividends, there was no proposal from the Republican side. On the Democratic side, there was a proposal to increase the tax rate to 28% on income above $1 million, and to also increase the net investment income tax to 5% on income above 400,000. It is currently at 3.8%. Now with tax credits, there was more robust proposal on the Democratic side. They want to increase the credit to $6,000 for children under the age of 1, $3,600 for children ages 2 to 5, and $3,000 for older children. They also want to expand the earned income credit to filers who do not claim children, as well as expand housing tax credits. From the Republican side, they want to create a family caregiver credit, as well as increase the child tax credit to $5,000. With regards to the estate and gift tax, there really weren't any proposals on either side, except for one of the main Republican proposals was to make the provisions of the Tax Cuts and Jobs Act permanent. So that would impact the estate and gift that we will talk about in a few minutes. From business taxes, the Democratic policy was to increase the corporate rate to 28%. They're also looking at creating an American Forward tax credit for certain types of business activity, mainly in things for energy production, to use solar, wind, and those types of things, to do technology and science to encourage that kind of innovation. They also are looking at clawing back deductions for depreciation and interest on certain rental construction investments. Now, on the Republican side, they were looking at lowering the corporate income tax rate from 21 to 20%, and also a further reduction in the corporate tax rate to 15% for companies that make their products in the US. A large part of the Republican platform, and you saw this in the Tax Cuts and Jobs Act, which we'll talk about a little bit more later, was to encourage domestic production, companies to bring their products back overseas, to bring manufacturing back into the US from overseas. So that's still part of those incentives. There's also been some proposals with regards to excise taxes. There were none on the Democratic side, but the Republican platform was to tax large private university endowments. Think, for example, like Harvard University, it has one of the largest endowments in the world. And as a way to raise revenue, to potentially tax some of those endowments. There were also proposals for tariffs and trades. There were no proposals on the Democratic side, but the Republican side was to impose a 10% to 20% tariff on all US imports and to impose a 60% tariff on all US imports from China. There's also a proposal that this could potentially replace personal income taxes because of the increased tariffs. Now, the fact of the matter is the odds of this ever going through are probably slim. We do have some taxes on imports anyways, but probably not to this extreme, because one, it probably would not increase the revenue that they think it would at first blush, because it would make the goods obviously more expensive coming into the US. So the prices would be higher in the US, not to mention these countries who we impose these tariffs on would probably do the same thing to us on our exports. So that would probably negate any potential revenue. Because remember, as I was saying, to get past that filibuster, you've got to have some revenue in there to try to balance any deductions you do. And this was the way the Republicans were wanting to generate a lot of that revenue, was through tariffs. So that was kind of the big thing with the presidential election and what the parties were thinking. Again, even though it looks like one side may have the majority control of government, when the Tax Cuts and Jobs Act was passed in 2017, the Republican Party had all three facets of government at that time, but it still took over a year to get the legislation passed, and there was still negotiation done, and the margins right now in the House are smaller than they were in 2017. So that's why there could still be negotiation. You could still see a mix potentially between the two platforms, which is why we wanted everyone to be made aware of that as part of that, even though we know the results of the election currently. So now we're going to switch gears and talk about the expiring provisions of the Tax Cuts and Jobs Act. So, as I stated, this law was passed in 2017. However, it was not made permanent because of that, trying to not have to do the filibuster, because while the Republicans had control of the Senate back in 17, they did not have 60 votes. And so a way to do this thing so it could come under the filibuster was to make a lot of the provisions sunset and go away in 2025 unless Congress does something. So there will be meaningful legislation more than likely done in 25 because these provisions will expire. And when they expire, we go back to pre-2017 on a lot of things. And with parties running to lower taxes, as you'll see, they're not going to necessarily want to see taxes increase. So what are some of the things that will end at the end of 25? One, as I said, the rates would go back down. The rates currently go from 10% to 37%. If the TCJA expires, we go back to the tax rates pre-2017, which range from 10% to 39.6%. One thing I want to draw your attention to is kind of the middle. So as you can see, when the Tax Cuts and Jobs Acts were passed, most people got a tax break because most of the country sits between that 12% and 24% rate, or in 2016, 15% and 28%. So people saw an average of about a 3% effective rate cut when the act was passed. So that would be, unless they do something, would be a tax increase for the majority of the country, just because you would go back to those higher rates. In addition, the standard deduction. So part of the big sale, if you recall, back in 2017 on the platform, was simplify the tax code, simplify the tax returns. Well, the one way they chose how they simplified it was increasing the standard deduction. So currently, if everything holds true in 2026 and the Tax Cuts and Jobs Act is made permanent, the standard deduction would be $15,450 for single or married filing separately, $23,150 for head of household, and $30,850 for married filing joint. This was a simplification because most people do not have more. Let's take a married filing jointly couple, for example. Most of the time, they're not going to have more than $30,000 of itemized deductions, because right now the things that make most people itemize their deductions are their mortgage interest, their property taxes, and their charitable contributions. Those are the three big things that get you over. Well, especially their mortgage interest. But most Americans do not have $30,000 a year in mortgage interest. However, as you can see, if we revert back, the inflated adjusted numbers for the standard deduction would be $8,350 for single married filing separately, head of household $12,250, and married filing joint $16,700. So there's a good chance a couple filing a joint return could have more than $16,000 of itemized deductions between their property taxes, their mortgage interest, and their charitable contributions. So they could tend to itemize. In addition, the $10,000 cap on state and local taxes would go away. The charitable contribution limit, which is currently 60% of your adjusted gross income, would get reduced back to 50%. The debt limitation for home mortgage interest increases to $1 million. And it also reinstates those miscellaneous itemized deductions we've not had. So the most common being hobby losses, accounting preparation fees, unreimbursed employee business expenses. So we get those things back if the act expires. But we also restore the P's limitation on certain itemized deductions. And essentially what this is there is a 3% subtraction for certain itemized deductions if your adjusted gross income gets above certain limits. So there would be some good things in the sense we would get more itemized deductions back. And I think you could see some of these come back anyways with any extension of the Tax Cuts and Jobs Act. But we know these things will be coming back if it goes away. Some other things. So you may remember a while back, we used to have a personal exemption. Well, that went away as part of the doubling of the standard deduction and the Tax Cuts and Jobs Act. But it would come back if the TCJA expires. So it would be $5,300 per person on the return would be the inflation adjusted number in 26. But you also see where the child tax credit, which is currently at $2,000 per child, would go down to $1,000 per child. Now, as we saw in the platforms, both parties are proposing some kind of increase to the child tax credit. So odds are, if we get meaningful legislation, that it will not drop. But again, if Congress does nothing and these rules sunset, it will drop. So again, that's kind of an increase in tax indirectly for people with families. In addition, we've been given an other dependent credit under the Tax Cuts and Jobs Act of $500 per other dependent that would go away if the provisions expire. Couple of other things, the estate tax. For 2025, the estate exclusion amount is going to be 13,990,000 per person. So huge number, does not affect most people. So we do not have a lot of estate tax returns being filed because currently that's such a high number that most people will fall under those exemptions. However, post Tax Cuts and Jobs Act, the prevailing wisdom is it's going to drop down, adjusted for inflation, somewhere in the 7 million range. A little more than 7 million, possibly, but it won't be 8 million. So that's still a big number because it's still per person, but it's still going to bring in a lot more people, obviously, because 7 million being basically essentially half of the current 13 million. So that is something to keep in mind as well. So that is kind of some hot topics that are out there that are going through to everybody that's on the mind between the recent election with these expiring provisions looming over us. So as I've said a couple of times, legislation is going to have to be done, or the party in power will be accused of raising taxes. And no party wants to be stuck with that because that is certainly, prime meat for the next elections coming up for the party not in control seeking power. So that's what we have on that. And now I'm going to turn it over to Lucy, who's going to start talking about some of the 2024 adjustments.
Thanks, James. Yes, so we looked at what could potentially be around, but now let's look at what happened in 2024 as we enter into the 2024 filing season. So we do have some adjustments to the tax brackets for 2024. Most of the amounts have gone up pretty significantly from the prior year, especially at the top rate. So these will be provided for reference at some point, but this is kind of a general overview for each filing status and what the tax rate will be once you hit this taxable income threshold. We also have some updates to long-term capital gains rates. So those are, there we go. Those are reflected on this slide. So capital gains, the max rate is 20%. And that's if you have over a certain amount of income. And just remember, once you hit that 20% rate, you probably are going to be subject, if not sooner, to the 3.8% net investment income tax. So if your modified adjusted gross income exceeds $200,000 for single and head of household status, or $250,000 for married filing joint status, you are subject to the 3.8% net investment income tax. So that is in addition to these capital gains rates reflected on this slide. These net investment income tax modified adjusted gross income numbers have not been and have never been adjusted for inflation. So these have remained the same since the net investment income tax was established. There are a lot of planning opportunities around maximizing your long-term capital gains rates that we'll get into at some point, but just know that you are subject to reduced rates for capital gains transactions such as selling property, selling stock, and flow-through items from partnerships. One item, sorry, James, if you don't mind going back. If you do expect a big long-term capital gain or short-term in 2024, it might be worth considering loss harvesting before year end. So you would talk to your broker and see if there are any securities or if there are any kind of capital transactions that you can engage in to harvest some losses to offset some of the capital gains that you have experienced in 2024 thus far. And if you have a lower tax rate, you might want to do the opposite. If your income is fairly low for the year, it might be worth looking into selling some securities to take advantage of a lower capital gains rate. So there's some fun things that you can play around with capital assets. Okay, now we'll move on to qualified business income. So this is the qualified business income deduction was established with the TCJA in 2017. We have some inflation adjustments below for phase in and phase out. But before I get into that, the qualified business income deduction is a deduction for those who have a sole proprietorship, flow through income from a partnership or an S corp, and you are allowed to take up to 20% of that income as a deduction. There are a lot of nuances to this deduction. It's not as simple as what's my income, let me take 20% of it. I think that was the intention, but in execution, it was not as simple. So when you are allowed this deduction, you are subject to phase in and phase out limitations. So I reflected the AGI thresholds in which those phase in and phase out restrictions will be enforced. So just note that you might be eligible for the qualified business income deduction, but if your income falls within these thresholds, you might be phased out of some of that deduction. Okay, now on to some tax credits. So we have some adjustments for the child tax credit. Currently, it is $2,000 per qualifying child under 17. The maximum refundable portion is $1,700, which is a $100 increase from 2023. This credit phases out for adjusted gross income over $400,000 for our joint filers and $200,000 for all other. That includes head of household, single, married filing separately. The child and dependent care credit, this is for kids under age 13 if you're taking it for your child. Expenses related to daycare, before and after school care, day camps, pretty much anything but tuition for schooling. It's 20 to 35% of expenses up to $3,000 for one qualifying dependent and $6,000 for two or more dependents. This has remained unchanged from 2023. And in order to take this credit, you must have earned income. That does not include interest, dividends, et cetera. This is wages or income from a sole proprietorship or a partnership. The adoption credit increased, so it's now $16,810 in adoption costs per child. It phases out at $252,150 modified adjusted gross income. I think that's across the board for all filing statuses. For education credits, the American Opportunity Credit is up to $2.5K per student, and the Lifetime Learning Credit is up to $2,000 per student. The education credits are subject to limitations, and only the American Opportunity Credit is refundable. There's all sorts of nuances with these credits. So if you're in school, you have a child or a dependent in school, it's worth talking to your tax advisor to see if you can take advantage of some of these credits for education. There is also the electric vehicle tax credit. This has largely remained unchanged from 2023. You get an up to $7,500 for new vehicles and $4,000 credit for used vehicles. You must meet additional critical mineral and battery component requirements. So you have to look at the car and it's subject to AGI limitations. So if you bought an electric vehicle, don't assume that you automatically get the credit. There are a number of restrictions on this credit because nothing is easy in life. So make sure that you're talking to your tax advisor to see if you can take advantage of these credits. And generally, if you do have a credit and say you're using your vehicle in business, these credits will reduce the depreciable basis of your property used in the business. So just keep that in mind too, if you want to maximize depreciation. Okay, now we are on to, let me catch myself up. Okay, these are some miscellaneous inflation adjustments. Kitty tax. You have, so the first $1,300 of unearned income that the child earns, so that's interest, dividends, capital gains, et cetera, is tax-free. The next 1,300 is taxed at the child's rate, and then anything above the combined 2,600 is taxed at the parent's rate. This is an increase, so this 1,300 of under the tax-free piece and the amount taxed at the child's rate, the total increased of by $100 from 2023. So you have an additional $100 before shifting into the parent's tax rate. So you get a little bit of a benefit there. For healthcare FSA, so this is flexible spending account contributions for 2024, you have a $3,200 per person contribution limit with a $640 maximum carryover. Looking forward to 2025, because I know we're all going through our benefit enrollments right now, it's $3,300 per person with a $660 maximum carryover. For health savings account, if you are only covered, just self-coverage, you are limited to a contribution of $4,150. And if you have family coverage, it is an $8,300 limitation on contribution. There is a catch-up contribution of $1,000. So for 2024, if you are self-employed, you can make your HSA contributions up to the filing deadline. So keep that in mind. So that's worth taking advantage of if you have not made your HSA contribution for the year yet. Looking forward again to 2025, the amounts definitely increase. So for your self-only coverage, you have a $4,300 contribution maximum, and for family, you have an $8,550. The 55 and older catch-up does not change. And the foreign income exclusion for 2024 is now $126,500. One thing I forgot to mention, HSA distributions are tax-free if used for qualified medical expenses, so you can contribute them. Depending on how it's structured, with if you're doing it through an employee plan, then you can get a nice tax savings, or by doing it through sole proprietorship, and then you have tax-free withdrawals if you use it for qualified medical expenses. I want to pause here if there are any questions. I think Chris is wanting to.
Lucy, could you cover who can contribute to an HSA or a health savings account?
Sure. So that is generally people who have earned income, whether through their whether through a W-2 or through a sole proprietorship or partnership, but you have to have some kind of earned income in the form of compensation. Most people, if you are employed, you might have the option of enrolling in your HSA through your employer, and you can make contributions through that plan. If you are self-employed, then you would set that up yourself and make contributions to the plan. Again, if you are employed, then any contributions made by you are a quote unquote above the line deduction. So it reduces the taxable income. So it reduces your wages that are taxable on line one. If you are self-employed, then it is a deduction. Again, an above the line deduction is just reported in a separate area, but you would reduce your taxable income, actually your adjusted gross income, by the contributions made to an HSA. I hope that helps.
I think it does, Lucy. And again, you have to be in a high deductible health plan, enrolled in a high deductible health plan in order to qualify for HSA contribution. So you'd have to look at your what type of health plan you're enrolled in, either through your employer or if you're self-employed, to make those contributions.
Correct. Yes. So you can't just make an HSA contribution if you already are covered under a non-high deductible plan. Okay, there are no more questions. I think we're ready to move forward to standard and itemized deductions. So for 2024, the amounts are as listed. They have increased, obviously, for inflation. Each taxpayer is eligible either to take the standard deduction or itemized deductions, with the increase of standard deductions, we're seeing a lot of taxpayers claim the standard deduction as opposed to itemized deductions, especially if you don't make large charitable contributions or have a mortgage on your home anymore. So but if your itemized deductions exceed the standard deduction, then you would obviously take those instead. The married filing joint standard deduction for 2024, as reflected, is $29,200. And that amount is split in half if you are married filing separately. And if household, you get a $21,900 deduction. Yeah, I think that's it for that one. Itemized deductions. I mentioned you get larger standard versus itemized. Itemized deductions include property taxes, state and local income taxes, medical expenses, subject to restrictions as shown here. So for medical expenses, they have to exceed 10% of your adjusted gross income. If you're 65 or older, that threshold is 7.5%. As James mentioned before, and this is a contentious item, state and local taxes are currently capped. And this state and local taxes, I want to also include property taxes, which include real estate taxes and personal property taxes, such as vehicles, boats, etc. That is currently capped at $10,000. Again, it is subject to change based off of who was elected and based off of what our Congress looks like. But currently and into 2025, it is capped at $10,000. Mortgage interest, investment interest. So mortgage interest is what you pay on your home or a second residence. And investment interest is on investment properties or, margin interest in your brokerage account. One item for state and local taxes. So there is a cap on state, local real estate, personal property taxes at $10,000. But if you hold unimproved land held for investment, that is not limited to the $10,000. So if you are sitting on a lot of land that is truly used for investment, and you would need to consult your tax advisor to confirm that it meets the criteria to be held for investment, you get that deduction in addition to the $10,000. So that is something to take advantage of. The mortgage interest limitation that I mentioned for primary residence and secondary residence, the principal balance is limited to $750,000 for debt incurred after December 15, 2017. If TCJA were to expire or things were to change, that principal balance would revert back to $1 million, and home equity debt would also revert. So you could get $100,000 for principal balance for home equity debt. Okay, that's all for deductions. I do see some questions coming through. Anything that we want to address, Chris?
I don't think so. I'll answer these questions as they come in.
Perfect. Okay, now we're moving on to gifts. So what is considered a gift? That is any transfer to an individual, either directly or indirectly, where full consideration is not received in return. Gifts to political organizations do not count as charitable contributions, but also gifts to political organizations are not deductible. So just keep that in mind. What are excluded from gifts? Tuition and medical expenses that you pay for someone directly to an institution. So if you're paying for a grandchild or a friend's child to go to university and you pay that directly to, say they're going to Harvard because they're brilliant, you pay it directly to Harvard, that is not a gift. Same if you pay it directly to Mayo Clinic or a medical institution. Those are not considered gifts. Gifts to your spouse are also excluded from gifts. There is some planning involved with gifting to spouses, especially with trusts. So, but the general rule is that gifts to your spouse are not included as gifts. The annual exclusion per recipient is $18,000 for 2024 and $19,000 for 2025. So this is, you can give up to $18,000 per person in 2024 without being subject to gift tax on that. And remember, if you are married, that is $18,000 per spouse. So you can gift $18,000 and your spouse can gift $18,000. So you want to take advantage of potential, or that whenever you're looking at your gifting for the year. Again, for 2025, that's up to 19,000. The lifetime exclusion per donor, so this is over your entire lifetime. This is also the estate exclusion, is 13.6 million for 2024 and 13.99 million for 2025. And this is doubled for married taxpayers. So take those amounts, double them if you are married. For gifting, if you have a 529 plan and you want to fund that, or you want to front load it, especially if you are in a state where you can get some kind of benefit from it in the form of a tax deduction. So being in South Carolina, we have a very favorable deduction for 529 plans funded into South Carolina. So we get a deduction for it, and a lot of our clients take advantage of front loading their 529 plan and allocating that contribution over 5 years for gift tax purposes. So they might not pay any gift tax on it, but they also get a deduction for it. So it is worth considering front loading 529 plans and taking advantage of the 5-year allocation. Especially, I mean, it's good to use as a gifting strategy, but it's also great if your state allows some kind of 529 deduction. And looking at where our audience is, I know a lot of the states that I looked into do offer some kind of deduction for 529 plans on state returns. They might not be as generous as South Carolina, but it is something. And just consider if you have to fund a state-specific 529 plan. Okay, now let's look into some charitable planning. So I mentioned that charitable deductions, that's an itemized deduction. So there are some ways to maximize your charitable deductions. You can alternate year donations. So if you are in a year where you have a big income event, it might be worth making a big charitable donation that year. A great way to do that is through donor advised funds. Donor advised funds are considered public charities, so they are subject to the same 60% limitation for AGI for cash donations and 30% for stock donations. So this is a great way to front load some charitable deductions, and then you can decide which organizations you want to donate to from that donor advised fund. The qualified charitable donation from your IRA has increased the amount that you can take as a qualified charitable donation deduction from your IRA. So if you get a distribution, from your IRA, take $105,000 and move it directly to charity. That removes it from your adjusted gross income. It's an above the line deduction, so this is not taken into account for itemized deductions. So this is a great way to satisfy your RMD requirement and reduce your taxable income if you have an IRA that you need to take deductions from. Age requirement to take the QCD is 70 and a half. Appreciated stock, as I mentioned, for donor advised funds, it's a great way to maximize your charitable deduction while limiting your cash outflow. And it's also a great way to reduce your capital gains. So when you donate appreciated stock, you don't recognize the appreciation as taxable income, and you get a charitable deduction equal to the fair market value of the appreciated stock. One thing I want to mention for appreciated stock in conjunction with the state and local tax limitation, if your state has a credit, like South Carolina has a South Carolina exceptional needs credit. I think a lot of the states I looked into have these SALT workaround credits. It might be worth looking into donating appreciated stock to one of these credits, getting a credit for the state by donating appreciated stock. So we have utilized this method where our clients will donate appreciated stock to the exceptional South Carolina fund. They get a credit for South Carolina taxes, and they have not had any cash outlay. So not all states have this. Not all states will allow appreciated stock to be donated, but I know for the South Carolina Exceptional Needs Fund, that is a great way for clients who might not want to pay cash to get a benefit. Okay, I do see a bunch of questions, any that we want to go over.
Lucy, can you mention for the qualified contribution deduction out of an IRA, are you also able to deduct that on your itemized deductions?
No, that's a good question. You are not. So if you take the QCD, you cannot take that again as an itemized deduction. So the qualified charitable donation is reducing your adjusted gross income, which is more beneficial than taking it on your itemized deduction. If you were to take, so you're allowed $105,000 qualified charitable donation from your IRA. If you were to take $110,000, that additional $5,000 taken from your IRA would then be moved to an itemized deduction, but you are limited to $105,000, reducing your adjusted gross income.
Okay, thanks. And another question that came in, if you're contributing appreciated stock into a donor advised fund, what is the amount of the charitable contribution you would receive for contributing that stock into that fund?
Sure, it is the fair market value of the stock as of the date received by the donor advised fund. It is limited to your adjusted gross income. So if you made a big donation of stock to your donor advised fund, but your AGI is too low, then you might not be able to take the full charitable donation in that year because you are limited to 30% of your adjusted gross income. Any charitable donation that is not taken in that year can be carried forward.
Okay, thanks, Lucy. I think we're ready to go ahead and proceed.
Perfect. Okay. So now we're going to look at some Secure Act 2.0 provisions and some retirement inflation adjustments. So let's look at our contribution limits first. So those have increased from 2023. To note, if you are self-employed with a sole proprietorship, and now I'm not going to tread on the businesses. They might be covering this later, but in the business webinar, which I hope you all will attend, if you are self-employed in a sole proprietorship, you can make these contributions by the employer contribution portion by the date that you file your return. That's including extensions. The employee contribution portion must be made by 12/31. So just remember that you have to make your employee contribution, but your employer contribution can be made by April 15th if you do not extend, or October 15th of the following year. But these contribution limits will be provided, so I'm not going to go over them, but this is them for 2024 and 2025. Contribution limits for IRAs. So for IRA contributions, both Roth and traditional, you must have taxable compensation. So just keep that in mind when making these. If you want, you can consider making backdoor Roth contributions where you make a non-deductible contribution to a traditional IRA by the filing due date, and then roll over the funds from an IRA to a Roth within 60 days. That is, you won't be taxed on the earnings of that, if I remember correctly. And so that is a great way to shift some of your traditional IRA earnings into Roth accounts. Another item to consider is our Roth conversions, especially in years where you might have lower taxable income, because that is a taxable event. If you expect to have high deductions or a low income year, consider making Roth conversions. These are all great, especially if you think you will have, you will be at a higher tax rate at retirement. Okay, now let's get into some Secure Act 2.0 provisions. A lot went into effect in 2024. Secure Act 2.0 has been around for a while, but each year more and more provisions come into play. So The first is additional exceptions. So this is exceptions from retirement distributions. These are subject to tax, but they aren't subject to the 10% penalty for distribution. So there's some additional exceptions for terminal illness, personal expenses up to $1,000, domestic abuse, that's the lesser of 10,000 or 50% of the participants' accounts. And this new item that was created, pension-linked emergency savings accounts. And this is at the employer level. So for terminal illness, it must be physician certified, and there is expectation of death in 84 months. For personal, this includes medical care, accident, loss of property due to casualty, foreclosure, eviction, funeral expenses, a number of items. Not more than one per year can be taken, and none can be treated as an emergency during or immediately following 3 calendar years unless the emergency distribution is recontributed or a contribution made post-emergency is equal to the distribution. So there are some, as everything, there are limitations on all of these, but there are some additional expense or additional distribution exceptions that were made with the Secure Act that came into effect in 2024. The new pension-linked emergency savings account, aka PLEASES, this is an employer-provided option to offer to non-highly compensated employees. The employers may automatically opt employees at no more than 3% of salary, and the portion of it, the account attributable to the employee's compensation is capped at $2,500 or lower as set by the employer. Once that 2,500 cap is reached, additional contributions can be directed to the employee's Roth defined contribution plan or stopped until the balance falls below the cap. So this is all very new. We're all still learning it. So this is, yeah, just bear with us as we learn that. I just wanted to bring it up in case that is something that you all as sole proprietors would be interested in. Inherited IRAs, the 10-year rule has come into play. So you must fully distribute assets by the end of the 10th year after the year the account holder died. There are some exceptions to this 10-year rule, mainly based off of what type of beneficiary you are, but just note that the stretch rule that was formerly intact before the Secure Act is no longer. So you have this new 10-year rule, and annual distributions are generally required by most beneficiaries. There is no penalty in 2024 for not taking the annual distributions, but there will be in 2025, and we'll get to that. There is a new option for 529 to Roth conversions. You can roll up to $35,000. This is a lifetime limit of unused 529 assets into the account beneficiary's Roth IRA. So if you establish a 529 plan for your child and the child did not go to college, then you can roll that up to $35,000 into that child's Roth IRA. The beneficiaries of the 529 and the Roth must be the same. You have to have owned the 529 plan for at least 15 years. The rollover cannot exceed annual Roth contribution limit. So it's 2024 increase for inflation in future years. So you can't do the full $35,000 at once. Like I said before, the beneficiary of the 529 plan must also be the owner of the Roth. The beneficiary must also have earned income equal to at least the amount of the rollover. Contributions and related earnings from the last 5 years cannot be rolled over. So you can't backload 529 plans to take advantage of the rollover. But if you overfunded in previous years, you could do that on purpose to then fund this Roth later down the line. And it must be a direct trustee to trustee transfer. Okay. The last provision for 2024 are student loan matching contributions. Employers may treat student loan payments as elective deferrals for matching contributions. The maximum student loan payment used for matching contribution is limited to the lesser of employees' compensation or the dollar limit on elective deferrals for that applicable year. This is for 401ks, 403bs, 457bs, and simple plans. The qualified student loan payment must be made by the employee for qualified education expenses. So some people use student loans for a number of reasons, but if they're repaying student loans that weren't used for qualified education expenses, then those would not qualify for this. Okay, we're going to get into the 2025 provisions that are coming into play. So these are as of effect as of 1/1/2025. So we definitely wanted to bring these up. So nobody is surprised by them. In 2025, there is mandatory automatic enrollment. Employers must automatically enroll eligible employees into a new 401k and 403b plans, 401k or 403b plans established after December 29th, 2022. The initial enrollment contribution must be between 3 and 10%, with 1% increases until it reaches at least 10%, but no more than 15. Employees can opt out, and there are certain businesses that are exempt. Those businesses would include those that don't normally employ more than 10 employees, businesses that established a workplace plan before December 29th, 2022, businesses that have operated for less than 3 years, and simple 401k plans and governmental and church plans. There are higher catch-up contributions for participants attaining 60 to 63 before the end of the taxable year. So it's a greater of 10,000 or 150,000, or I'm sorry, 150% of regular catch-up limit adjusted for inflation. So those amounts were provided in the contribution limit slide. So you will have that higher catch-up limit for 2025. It's expected to be 11,250 for participants 60 to 63. Last, I mentioned this before, the inherited IRA required minimum distribution penalties take effect in 2025. So there's a 25% penalty for those not taking annual distributions from inherited IRAs. So in 2025, if you have an inherited IRA or have clients that have inherited IRAs, it's worth looking into seeing if you must take distributions, and if so, start the process now to ensure that you are taking those distributions so you don't get hit with this 25% penalty. Okay, that's what I have for now. I don't see any questions, but Chris, I'll leave it to you.
Yeah, thanks, Lucy. I think we've been able to answer the questions that have come in either during the webinar or via the Q&A panel. So I appreciate everyone submitting those questions. We're coming to the top of the hour, so I think we'll just go ahead and wrap things up here. First, I want to thank our presenters today, James Wright and Lucy Brenner. Have devoted a lot of time and effort in getting this pulled together. So I want to appreciate their time. Also want to encourage folks, if you like what you heard today, want to stay on top of trending events, connect with CRI on our various social media platforms. We post updates as they become available. So if you want those updates as they occur going into 2025, make sure you connect with us on your preferred platform. I'd also like to thank all the attendees for taking an hour out of your day to attend this webinar. I know time is precious, so I hope you were able to glean some pertinent information from this webinar. And of course, if you have any follow-up questions for your specific situation, feel free to reach out to your CRI professional or any CRI office, and we'll be happy to dig into more of the details with you on your personal situation. So with that, thanks everyone for attending, and we will wrap up here.